Hey, what's up, investors? Jeff Beers here from 40 Finance Channel. Today we're going to talk about why are stocks going down right now, particularly tech stocks and some of the more popular retail names. While the stock market itself hasn't been in a huge crash or correction, we have seen a lot of popular names on the downswing. Now, at its core, the stock market is a very simple supply demand type platform. The more demand there is for a stock, typically the higher the price goes. And as more people sell off or more supply comes through dilution or split shares or anything like that, then you can see the price go down if there's not enough demand to pick up those shares. Now, when it comes to small investors like myself who are buying 10, 20, 50 shares of a stock, that's not really going to have that big of an impact. But that typically extrapolates into other big buyers, which could be ETFs, hedge funds, index funds. Those are the type of buyers and sellers that really can move a market because they're dropping thousands and thousands of shares on every transaction. So when you start to see momentum turn in a stock, and there's a lot of reasons why people buy or sell. We'll talk about those in a minute. But when you see the momentum turn on a stock, it really can take off quickly. And some of the popular retail names that we've seen out there, in my portfolio, Enphase Solar would be one of the big ones. It was trading around $220 some back in January or so. It's now down to $145. Nothing's changed for Enphase as a business. They did not lose a patent or suddenly announce that sales were going to be bad. None of those things came into play. In fact, arguably, with a Democratic president who's going to have a focus on renewable energy, things are going better than they were a year ago for Enphase. But solar stocks in general, along with EV stocks and some of the tech stocks, have sort of reached a saturation point. Then you saw a little bit of weakness at the top, and that's kind of turned into a momentum of weakness where, every step along the way, more people are getting out of stocks like Enphase, and that's brought the price all the way down. And when you have big fund managers and index funds and insiders seeing the price go down, after a certain point, they start to sell off too. And that, again, it's a snowball down the hill with some of these names. So when does it all stop? Typically, it stops when you get to a valuation criteria. Now, there's plenty of different valuation criteria you can sort through on a stock, and every investor has their favorites. I'm sort of old school, so I kind of stick with the PE, EPS argument, but I do monitor things like price to sales, PEG ratio, things like that, just to make sure that there's nothing in the PE that would be leading me astray from some of the other core fundamentals. The catch is, though, on the upside. So when, let's just say Enphase went from $100 to $200, during that stretch, it had the momentum to the upside, right? And typically, upside momentum buyers are less concerned about the core valuation metrics than people who buy on the downside. And there's a lot of reasons for that, but most notably because momentum trading has become such a big thing. If you think about day traders, if you think about the importance of ETFs in order to, hit their returns for a year, they could jump into a hot stock for a short amount of time and then come out. There's a lot of reasons that people jump into momentum on the upside, but there's a percentage of upside that has absolutely nothing to do with fundamentals, and we've seen a lot of that this year. Solar stocks, EV stocks, some tech names, certainly SPACs. All those stocks that you kept hearing on the news were overvalued, or how's it trading at this valuation? Well, it was continuing to go up and it never let traders down. So the upside momentum was strong, which essentially disregarded valuation metrics at its core. Now, what's really interesting about this particular bull market, especially in the second half of last year, was the whole psychology of the market was this diamond hands, holding strong, to the moon, all that stuff, which we kind of joke about. But there was a lot of people who felt great about all of their purchases because they really did keep going up. But here we are today as we see a little bit of melting going on, and you see how quickly the momentum can change when you go back to the first week of March, right around the 4th or the 5th. We had some pretty decent selling at that time. And right now, instead of like a crash or a major correction, in my opinion, we're just seeing this meltdown, right? Very slowly over time, some of the most overvalued names, at least from a fundamentals perspective, their prices are coming back down as the diamond hands and the rah-rah crowd starts to realize, whoa, what really is holding this stock up? You know, why is this stock at this price? Everything I learned about fundamentals says it shouldn't be here, and maybe we're a couple years early on this one. So don't be surprised if you continue to see more melting come down, but here's where it can stop. This is the next part of this video, and that is, what is the bottom, so to speak, or how do you get these stocks to start bouncing back up? So in order for these stocks to recover any of their losses, you need the opposite of selling. You need buyers. And one of the things with the stock market on the buy side, particularly in a downward momentum buy side, you're going to have valuation shoppers, many of whom are like myself, who are typically rooted in fundamentals. We have some Enphase, we have some Unity software, Palantir. Those are just three that I have. But for the most part, we are rooted in fundamentals. And with that being said, there's a lot in this market today that if you really wanted to go after a value approach, there's probably more room to run on the downside for many stocks. Now, one of the things, in my opinion, that you need to be super careful of right this second with stocks is the crowded trade, right? Which is folks shifting from one side of the stock market to the other. It's been on the news a lot like right now, where they're talking about getting out of tech and into value plays, particularly travel plays. And I would advise you to be very careful with this mindset, because I don't think that travel is offering a true value trade. All right, so if you leave your tech stocks behind, you're inheriting a loss. To flip over to travel, where you're making the assumption that those are going to run up and you're going to get a bigger gain for your buck. And my argument, which we'll look here in Hilton, is if you're scared of these stocks going down and you're going to transfer to stocks that technically have the upward momentum, you might find out that you're going to end up right at the same place when it's all said and done. All right, so this is Hilton stock, 1 year chart, you know, back down in the low point, you're at 55.94. Today you're at 119, 120, and this is 100% looking ahead because you can see this EPS here, minus 250. If we go to the 5-year chart, this is the part that I find really kind of interesting about the value travel stock transfer, and that is travel stocks are trading higher than they were last December or December 2019. So there's it's not here, right? It's not in $60, $70 land where there's obviously room to go. These things are right here at the top and actually have exceeded the 2019 top in Hilton's case. Now we take a look at some of the historical valuations over the past. P ratio, granted this is trailing 12 months, so no surprise, 643, way out of hand, but that's everybody's betting on the future of Hilton, so we'll disregard that. We'll look at forward PE of 44. It doesn't take you very long. This is 2014. right here, 2014, 15, 16, 17, 18, 19. Hilton has, let's see, only a couple times in that stretch did they trade in the 30s. 2017, they were at 33. Heading into the end of 2020, they were at 43. And now they're inching even higher to 44. So even on a forward PE standpoint, you're buying Hilton more expensive today than you ever have. And what the market is saying here is that they believe the projected earnings are actually going to be more, in this case, seemingly significantly more than is being projected by analysts. Now, if you go by price to sales, here, Hilton's had a pretty good price to sales ratio. 1 is awesome. They were riding in the 2s, and it's trailing 12 months, so they're at 7. But, you just have to be careful where you're buying stuff at because even though this is a trailing 12 months metric and you'll have to monitor it over time, you can go back and calculate where the sales were in 18 and 17 and put together your own thoughts on if they can hit that in the next 12 months. All right, last chart here. This is from Seeking Alpha. This is consensus EPS estimates for Hilton. This gray or whatever it is area shows you the past, the ones that are locked in. This is the future. Obviously, Hilton has a lot of bright side in the long term. A lot of companies do. This isn't just a Hilton chart. There's a lot of charts that look like this going forward. But if we go down to our P metrics, if you plug it into December 21 and you go by the EPS estimate, your forward PE is 60. Then in 22, it gets to 31.40. So remember, December of 22, that is give or take 18 months away. And then December 23, you're back down to the historically normal forward PE for Hilton. So jumping in Hilton today to so-called transition to value and leave your tech stocks, sell out of your tech stocks and take a loss, in my opinion, you're not going to find the value that you're looking for. All right, so bottom line here is you can look at your portfolio and see which stocks are being killed at the momentum point, right? Everything that was trading so well for so long is now slowly but surely coming back down. It's out of gas. It's out of buyers. There's nobody else buying that stock. And while you might see some roller coaster rides along the way, the current sentiment for these retail popular stocks, it's just not there to hold it up. There's not enough buyers to keep the price moving or recover the losses that they've seen. And what's interesting about the whole thing is it feels like the market is shifting away from tech and popular names into industries like travel that are not at rock bottom prices, okay? So just be careful where you transition. For myself, I am doubling down on the names that I believe in, even the ones that I bought at prices that have come down since. We'll see how that turns out. But I holistically believe in companies like Enphase, or else I wouldn't have bought it in the first place. And my timeline of 3 to 5 years still makes it an opportunity. So if I keep seeing it going down, I'll just be lowering my cost basis. All right, guys, hope you enjoyed this video. Please give me a like and subscribe if you did. We'll see you on the next one.